Hi, Joe Lopresti here with our latest proactive investment strategy update for Friday, August 26th. Well, since our last update, our proactive market model did trigger a global buy signal about 2 weeks ago. In fact, it was on the date that we recorded our last update. We don't really know that until the data is processed that evening. What I'd like to do in this update is walk you through the scenarios of how that developed. We'll start with walking back earlier in this year to kind of set the table, and then talk about how we see this particular signal playing out in the weeks and months ahead. So let's take a step back to earlier this year. In fact, coming into the year, our market model had triggered tactical sell signals, indicating that in 2021, equity markets reached an unsustainable level, and we would eventually see some give back of that gain. We didn't know to what extent, just that things were overextended on the upside. And as the correction started to develop earlier this year, the market model then moved to a global sell signal on April 22nd. We consider the global sell signal our tornado warning system, right? So when the siren goes off, we head to shelter, we ride out the storm. We don't know how long it's going to last. It could be a quick one, 2 or 3 or 4 months, or it could be very long and damaging and last a year or two or longer. The storm may pass quickly. If it does, our indicators sound in all clear. However, if the tornado hits, we're in shelter, we're protected. Right? So when our model triggers a global sell signal, we sell assets to preserve wealth. These are strong warnings in our model, the strongest that is available. So we move to eliminate risk at that point. Active risk management is really a critical part of our proactive investment approach because wealth preservation is important to our clients. It's their top concern. After moving to the sidelines, we then design the model to re-enter the market based on a couple of different types of conditions. The first is a global buy signal, and that occurs when our core indicator set returns to a positive status to indicate the market's trend is healthy again. At that point, we conclude the storm is over, the storm is past, and a new bull cycle has potentially begun. The second condition for re-entering the market is a tactical buy signal, indicating that as stocks dropped during the bear market, it reached a very low risk level, unsustainable level, kind of the opposite of a tactical sell signal, the tactical buy signal. And that usually suggests that we're at a reasonable risk to reward, entry point in the market. Now, we don't know when that tactical buy signal occurs, if it is going to mark the ultimate low in the bear cycle or just a temporary one. But ideally, the selling climax, the tactical buy signal, leads to a new bull cycle with a global buy signal. So on July 14th this year, we did get the tactical buy signal as we reported in previous updates. When that happens, we begin investing capital, expecting the oversold level in the market to be a good entry point. The amount we invest after a tactical buy signal depends on a couple of variables. One is how many of the 11 selling climax sub-indicators that we have confirm that a panic of some sort has developed. This year, about 6, well, in fact, exactly 6 of the 11 confirmed, so 50 to 60% or so. The second consideration is the position of our recession warning models. If there's no recession warning, we invest more confidently with a tactical buy signal because that very well could have marked the low for the bear cycle. We know that bear markets without recessions are short. They average about 5 months. Well, if the June low ends up being the low, This one was a little over 6 months. If there is a recession warning, we move more cautiously because we know that recession-driven bear markets are longer. A tactical buy signal during a recession-driven bear market may not mark the ultimate low. Stocks could rally temporarily, only for the bear market to resume at a later date. So this year, again, the tactical buy signal occurred July 14th. 6 of the 11 sub-indicators confirmed the signal. The recession warning models have been mixed. We've been reporting that for the last couple of months now. Some are warning a recession. They're in that territory. Others are holding up. So after the tactical buy signal, we moved approximately 30% of the cash back into the market. And when we get a tactical buy signal, we're not selecting specific asset classes. We're moving back into broad-based market-related investments, index type of investments. Then about a month later, 2 weeks ago, August 12th, the model improved to the global buy signal. And that's a sign the storm has passed and a new bull market is potentially beginning. And after that signal, we invested more cash over the course of the last 10 days or so, moving approximately 65% total back into equities. When we get a global buy signal, we want to move into specific asset classes according to each strategy selection method. So for example, we used our asset class ranking system to identify potential leading groups. The asset class leadership is going to vary cycle to cycle based on the financial conditions, the economic variables that are in place during that cycle. So we use a proprietary formula to rank hundreds of different asset classes. So that includes industry groups, foreign markets, commodities, investment themes, etc. We designed the ranking algorithms to identify asset classes that exhibit specific characteristics of leadership. So in short, this helps us separate out the stronger and weaker groups to help us focus on the potential leaders if this buy signal develops into a new bull market. And if that does happen, based on extensive research, we have very good reason to believe that the selected asset classes are likely to lead the market forward. So in our PAS ETF strategy, we purchase exchange-traded funds to gain exposure to these specific asset classes. And in the PAS stock strategy, we take that selection one step further, whereas the PAS ETF strategy will own funds consisting of baskets of stocks. The stock strategy will focus in on the potentially strong stocks in those leading sectors. So this is a good time for us to go to our asset class ranking system. We're looking at the date of the signal, August 12th, and you'll see highlighted in green the specific asset classes that our ranking methodology selected. So solar energy was the top ranked asset class. The semiconductor and equipment industry group was very high ranked. Notice that that's mid caps, so not particularly the very large semiconductor companies, interestingly, but kind of that mid-tier group. Lithium, which is a thematic industry group, or I should say asset class, as is the solar energy asset class. Natural gas commodities, the automobile sector, foreign market Chile, and the steel industry group as well. So those are some of the specific asset classes that our methodology selected. And with the ETF model, we'll buy exchange-traded funds that give us broad exposure to solar, semiconductors, lithium companies, etc. In our stock model, we take that one step further and rank all of the individual companies within that are owned by these ETFs and identify the potential strongest stocks within what sectors we believe will be strong. So if the bear market concluded, it lasted a little more than 6 months, the MSCI All Country World Index dropped about 23%, not a severe bear market, right, but meaningful enough. Moving to the sidelines during that time provides peace of mind during an uncertain time, even during short bear markets. Now, global buy signals are typically a solid investment time for at least an intermediate period. But it's essential to know that there have been a few signals, buy signals, that were false starts. And those occurred during the very long bear cycles. Hasn't happened for a long time. In fact, the last one happened way back in the 2008 bear market. Prior to that, in the 2002 period, when, after the tech bubble burst and the fallout from that particular bear market. During those previous bear markets, the economy experienced a recession that caused the bear cycle to extend for longer periods than is typical without a recession. Our recession warning models in this cycle have been inconclusive for the last couple of months. Specific models warning of recession, others not. The success of this global buy signal could depend on the economy's path. If we avoid recession, we believe the market low may be in the past. If a recession occurs in the coming months, then the market rally could be short-lived and the bear market can resume. So the way that we're approaching this is, first, we didn't move to a fully invested position as our models are designed to do after a global buy signal. We moved about 65% invested. So that's one discretionary step that we took away from the model. The second is we're looking at the recession warning models very, very closely. And in fact, next week we'll get two key recession warning models updated. And if there's any change, and these are the two that are really still holding on to positive readings, any change there would cause us to take some action to reduce the amount invested in the market. Because if the recession models that are currently negative improve, we expect that the market has hit bottom. However, if the models that are positive turn negative, then this may be a false start, and a second global sell signal could occur extending from that. False starts typically become apparent relatively quick, 1 to 2 months. And that fits squarely into the election cycle as well. We know September, October in midterm election years tend to be a bit more difficult times than in non-election years. So we're going to track the progress of this global buy signal. I'll show you exactly how we're going to do that, and we will provide insights that we see developing along the way. Let's take a look at our overbought, oversold indicator, and we're looking at the period that defined the bear market as we saw it from our sell signal April 22nd to the global buy signal on August 12th. You could see where the selling climax signal occurred, very close to the low as the market retested the June low in mid-July. And then there was a nice rally that followed. And now if we bring this forward to include what happened since the buy signal, you can see now we have a bull trend channel chart started. If indeed this buy signal takes hold, we expect the market to trade in this channel and not the bear cycle channel, right? Now, so far there's been a bit of a pullback since that buy signal. That's not uncommon, as you're going to see in a minute. So now that we have a global buy signal, one of the things that we want to do is track the progress of this signal. And we call these the vital signs following a signal. So we're looking at all of similar type of signals, global buy signals mostly. Some of them are confirmed up signals, which is a bit different, but a similar setup to the signal that we just recently experienced. And then we look at the signals that were a success and the signals that were false starts. Right? So the signals in green were all successes. In other words, market trends followed through to the upside and there were good, solid investment opportunities in the following months or even years following those signals. The ones shaded in, I don't even know what you would call that. Yeah. And these other signals that are not shaded in green are the ones that we would consider were false starts to a new bull cycle. So you can see one hasn't really happened since 2008. So it's quite some time ago. Ever since then, we've generally had good follow-through to global buy signals. Now, I do want to mention that this is our research. This is used for us to be able to understand market tendencies, to make informed decisions moving forward. Some of these signals were used in actual production in our model. Others were pre-use of the model. But this helps us understand, based on previous global buy signals, how we could expect this one to proceed. So the first thing that we're looking at are the recession warnings. And what we tend to see is the ones that are successful, there are a couple where the recession warnings were still warning of a recession, and that's noted by these negative numbers on the chart here. But most of the positive or successful global buy signals, the economy was fine, and our recession warning models were not negative. So when we break it down, we could see that the unsuccessful tend to be more in line with a recession, weak economies. So with this particular signal being questionable still on exactly what is taking place in the economy, it's a bit suspect. It's one of the reasons why we moved a little more gingerly than we normally would if there was no recession warning. So there's a lot of information on this spreadsheet, and certainly we're not going to go through all of it, but another key item that we're observing is what happened with the market overall following the successful signals versus the unsuccessful ones. And what we see is with the unsuccessful ones, the market obviously stumbles, right? So this is the MSCI All Country World Index. The successful signals, we see some positive follow through. So following a successful global buy signal, on average, the MSCI All Country World Index went up 26% to the next signal. That next signal came some 835 days later, so a very long time. If a global buy signal takes hold, they generally last a significant period of time. So the buy signals that failed, the market dropped about 4% until we got the next sell signal. And that only took 41 days, and these are business days in terms of a median. So that's approximately 2 months. So when a global buy signal does fail, it tends to happen pretty quick. And that's why I said earlier, generally within a month or two, we know that this is kind of following the path of a signal that will not take hold and will need to move back into wealth preservation mode if that happens. But it's just too early to tell, and really at this point, early on in a cycle, this one's doing very similar things to both positive and negative. So we're tracking one of our computer models, the PAS ETF computer model, not our managed version, but a computer version which is fully invested. Our managed version is less than fully invested. And we could see during the positive or successful campaigns, after 9 days, which is what we're into this one, it's up on average, but it's up on average during the unsuccessful ones as well, right? So currently it's down a fraction, less than 0.5% coming into today. Then we'll track the MSCI All Country World Index itself. And once again, we could see what happens with the successful signals. We could see what happens with the unsuccessful ones, right? Typically at this stage, in both cases, the market's up a little bit. But really when we start getting into day 20, we could start to see a difference between what's happening in the market with the successful global buy signals, what the false starts look like as well. So there's still a little bit of time until we get to that point where we could really start to determine if this one's following the path of the successful versus the false start. We look at a whole host of additional information. So this is the VIX, or the volatility index. And we see generally in both cases early on the VIX is falling. Whether it's successful or unsuccessful, it's really not until sometime later, as we get into day 25, that we could start to determine the difference between what happens with a successful signal and what happens with an unsuccessful one. So let's hone in on a period of time when there were a few unsuccessful or false starts. We're going quite a ways back in time here, about 20 years ago. And what we're looking at is the sell signal that happened in the year 2000 following the tech stock bubble. You could see in September, this is the previous trading. That was the market high in March of 2000. This is when our model, again, using this for research purposes only, this was not actual use at the time. And you could see the bear market took hold, and the market traded very well in that bear trend channel until right about here when a global buy signal developed. And that was in late 2001. You could see that global buy signal, as noted by this little thin light shaded blue period, lasted just a short time. It was a false start. And then there was a second global buy signal in 2002, and that lasted for just a short time until another global sell hit and a next leg down in this extended bear market took hold. And there was even a false start here in early 2003 until the final global buy signal occurred in April of 2003. Now, that's an unusual period, but obviously can happen during extended bear markets, and particularly ones driven by recession. Now, let's put that all into perspective, and we could see the global buy signal that happened way back here in 1995 on how that just proceeded into a very long bull cycle until that peak in 2000. And then during the bear cycle, generally, the model's negative except for very short periods here until the global buy signal that really marked the low and turning point for the market cycle. So if we look at what happened the following years after that April 03 buy signal, once again, you could see that was the successful one, and it developed into a very long bull cycle, as did the successful 1995 buy signal. Now let's take a look at the last 10 years when all of the global buy signals follow through to the upside. You could see following short sell signals in our model, say back here in 2012, a successful global buy signal. And this was a sell signal period, and following that, a successful global buy signal, successful global buy signal. And then this is the latest decline and new global buy signal. So if we come back and look at the vital signs and the tracking, 3 of those false starts all happened within a very short period of time during that very long extended 2000 to 0203 bear cycle. There was one short period as well during the 2008 bear cycle that developed into a false start. So we know certainly the odds are that this buy signal will be successful. But a lot of that depends on the economy. And if the economy turns negative and our recession warning models point in that direction, we're moving to the sidelines. We're moving back into wealth preservation mode. This bear market may not be over. If it is, we expect this to be a solid long-term opportunity in the market. And really, when we get a buy signal, we never know if it's going to be this long, successful one like we've seen in recent history, or one of these very long, successful bull cycles that develop, or one of these false starts. So now that we have a global buy signal, we'll be tracking the path of this particular buy signal and its vital signs to see if it's developing into a typical successful signal versus one that could be a false start. We'll be following our recession warning models. And in fact, next week we'll get some important updates. If there's any changes there, we'll notify you with a flash alert. Well, that's going to conclude this proactive investment strategy update. Thanks for watching. Enjoy your weekend.